Hello all, I am Keerthika from 2nd MCom Tyagarajar College. Now we are going to discuss about designing capital structure. Now we are going to see about the definition of capital structure. According to the definitions of Gerstenberg, capital structure of a company refers to the composition or makeup of its capitalization, and it includes all long-term capital resources. And according to definition of James C. Van Horn, capital structure is the mix of a firm's permanent long-term financing represented by debt, preferred stock and common stock equity. Now we are going to see about what is capital structure. Capital structure refers to the amount of debt and equity employed by a firm to fund its operation and finance its assets. A firm capital structure is typically expressed as a debt to equity or debt to capital ratio. Equity capital represents ownership in the company, entitling shareholders to a portion of future profits and cash flows. It can include common stock, preferred stock, or retained earnings. Debt is obtained through bond issue or loans, which the company must repay over time with interest. Short term debt is also considered as a part of the capital structure. By determining the right mix of debt and equity, companies aim to optimize their cost of capital while maximizing shareholder value that help for the growth opportunities for the business. Here is a pictorial representation of capital structure which is categorized through the debt and equity. Now we are going to discuss about the dynamics of debt and equity. Debt investors take less risk because they have the first claim on the assets of the business in the event of bankruptcy. For this reason, they accept a lower rate of return, and thus the firm has a lower cost of capital when it issues debt compared to equity. Equity investors take more risk as they only receive the residual value after debt investors have been repaid. In exchange for this risk, investors expect a higher rate of return, and therefore the implied cost of equity is greater than that of debt. Now we are going to see about ideal capital structure. An ideal capital structure represents the optimal blend of debt and equity financing that maximizes a company's market value while minimizing its overall cost of capital. A company with more debt than equity is said to have an aggressive capital structure which can have drive higher growth rates but comes with increased financial risk. A conservative capital structure is where equity exceeds debt, that offers lower risk but may result in slower growth. Now we are going to discuss about the types of capital structure. There are four types of capital structure: equity capital, debt capital, hybrid capital, and optimal capital structure. We are going to see this in detail. Types of capital structure. The primary purpose for analyzing the capital structure of a company is to determine how to allocate funds between equity and debt financing to optimize the company's overall cost of capital. Equity capital. Equity capital is the capital raised by issuing shares in the ownership of a business. In return, shareholders are entitled to share in the profit and a portion of the assets if the company goes out of business. Equity financing can come from existing shareholders or new investors. Debt capital. Debt capital is the most common capital structure in most organizations and includes taking out loans from creditors like banks, credit unions, or bondholders. The borrower promised to repay the debt with interest. Debt financing can be an excellent option for businesses that have a stable cash flow. Hybrid capital. Hybrid capital, also known as mezzanine financing, is capital structure that combines both equity and debt financing. Hybrid capital usually grants the lender the right to purchase equity in the borrower, making it a quasi-equity investment. This financing involved higher cost than other financing options but is less risky than equity financing. Optimal capital structure. Optimal capital structure refers to the mix of debt and equity financing that maximizes a company's value by minimizing the cost of capital. It involves determining the right balance between debt and equity to achieve financial goals like reducing the cost of capital, maximizing return and cash flows, and ensuring financial flexibility. Now we are going to discuss about importance of capital structure. Cost of capital. Determining an optimal capital structure helps minimize the overall cost of capital, balancing the expenses associated with debt and equity financing. Risk management. Properly structuring debt and equity helps manage financial risk by spreading it across various stakeholders and optimizing the company's risk return profile. Tax benefit. Utilizing debt in the capital structure offers tax advantages through deductible interest payments, reducing the company's tax liabilities and enhancing profitability. Shareholder value. Maintaining an appropriate capital structure contributes to enhancing shareholder value by optimizing the balance between debt and equity financing to maximize returns. Now we are going to see the formula for calculating the capital structure. The calculation of capital structure can be done through this formula. Capital structure is equal to debt divided by debt plus equity. Here, debt refers to the total amount of debt financing used by the company and equity refers to the total amount of equity financing used by the company. Thank you for the opportunity given. Thank you.